Big Daddy Dalio is not happy with everybody talking about economics. Because you know macro is his area, so he gets a little feisty when people talk about things that he says they don't know about. He said, for me, hearing supposed experts talk about what's now happening in the markets and the economy is like listening to nails scratch against a chalkboard. Because they're typically saying incorrect things in an erudite rather than common sense way. Basically, he's saying they're talking a lot, but they're not saying many true things. So, of course, Dalio, our favorite LinkedIn influencer, I know a few people that are LinkedIn influencers now, and it's very embarrassing. Why Dalio posts his stuff on LinkedIn, we won't know, but it is good stuff. And he's here to explain what's really going on with inflation. So what he's hearing a lot of is that people are saying inflation is a big problem. Obviously, yes it is. But all the Fed needs to do is just tighten to fight this inflation, and they'll make things great again once inflation is under control. But this is naive, and it's inconsistent with how the economic machine works. And the reason why is because it's only looking at inflation as a problem that the Fed could just tighten to fix. People are thinking it's just a low-cost action. They'll make everything better once the inflation is gone, but it's not like that. Because in reality, the reason we have inflation is because prices rise when the amount of spending increases by more than the quantities of goods and services sold increase. Meaning our demand is rising faster than the supply. That's why prices are going up. That's why we're getting inflation. And the way central banks fight inflation is literally by taking away money and credit from people so that they can reduce their spending. Now, the Fed can't go in and affect the supply side, can they? Like, they can't work on the supply chain. They're not going to do that. So the only thing they can affect is the demand side. And the way they're going to affect the demand side is by decreasing demand. And if you decrease demand, what's going to happen? Inflation will slow down. But it's a rough way to do it, and that's Dalio's point. Because by raising interest rates, you're taking buying power away. Because with those higher interest rates, the amount of money that has to go towards paying that interest is larger. And if you got to pay more money towards your interest payments, then the amount you could actually spend is lower. And if you can't spend as much, then you're not going to be able to push up the prices of goods. Thereby, inflation would come down. Raising interest rates also lowers spending because it lowers the value of investment assets. And that's all because of the present value effect, right? Like when you're trying to do the present value of a certain company in the stock market, if interest rates are higher, that present value is going to be lower. Which is why when we see interest rates going up, we see the stock market coming down. It not only has to do with the economy, but it also has to do with specific valuations of those companies and their stock prices. So the fact that investment assets lose their value means that we have less buying power. If your portfolio was cut by 30%, which a lot of people's were, you're not going to feel like spending as much, are you? Because your nest egg has taken a pretty good hit. Even though it's all paper money, it still has a big impact. So the main point is that while tightening reduces inflation because it results in people spending less, it does not make things better because it takes that buying power away. So inflation comes down, but now we can buy less because we have such high interest rates. So really all it's doing is just shifting some of the squeeze that people were feeling from inflation to a different squeeze that they'll feel from having less buying power. And he has a little note right here talking about Paul Volcker, who used to be the Fed chair back in the late 70s and 80s. So he had to increase interest rates like crazy. It was a bone-crushing tightening. And that was followed by an improvement of conditions in the 1980s because the 70s was just so much inflation. It was a rough period. But he's saying you got to realize that it took a rise in real short rates to 8.4% and an economic dive that took the unemployment rate to 10.8%. That's what reduced the spending enough to lower inflation. And another thing that happened is that foreign countries, the debtors in those countries, they really got squeezed. And they had to cut spending a lot, and that put them into 10-year long depression. Because the US dollar is the reserve currency around the world, right? So if interest rates are going up, it's becoming expensive for everybody, not just in the US. So foreign countries got it really bad. 10-year long depressions is what they suffered through after that. But all in all, the inflation, the crazy inflation in the 70s, it was reduced by people and companies being painfully squeezed and reducing their spending. It wasn't just the interest rates, it was the reduce in spending. That's always the case, and it's going to be the case this time too. See, the only way to raise living standards over the long term is to raise productivity, and central banks, they don't do that. So central banks, what they really do is just move demand around, and they do that by providing and withdrawing spending power. And that's done by influencing the creation and amounts of debt assets and debt liabilities. And this is through their interest rate management. management. And when they're doing this, obviously we get cycles in the market. We get bull and bear markets and expansions and recessions. So we know the Fed likes to print, right, and stimulate. So they inject credit and money into the system, and that produces an increase in demand for goods, services, and investment assets. That's what we've been talking about forever, right? If you keep printing like this and you keep injecting money into the economy, we're going to get that inflation. And you get over expansion, which is exactly what we got. So after they do all that pumping, we get periods where we got to pay all that back. And that's when we get the lows in the demand that are depressing, and we get recessions. But whenever these depressing periods get too depressing, the central bank kicks back in and they do another even bigger dose of stimulation. And this is really the short-term debt cycle, which we've talked about a lot on this channel, also known as the business cycle. And this lasts for about 7 years, give or take. But we also know when they're raising and lowering rates, they're doing it at lower and lower levels. So the Fed lowers rates, we have our big expansion, things become too hot, they raise rates again. But they don't raise rates back to the point where they previously were, they raise them a little lower. And then when they lower them again because things become too slow, they're lowered a little bit lower than they were previously. So you have a chart that looks like it's going down like this. And that's what creates our long-term debt cycle that typically lasts about 75 years, give or take about 25. And you know, the Great Depression was the end of the last one, and we're about 100 years from then. So yeah, you know what's going to happen. And the reason why the Fed keeps, lowering that rate and we get the long-term looking like that is because the debt assets and liabilities that are created in each cycle keep piling up. They get unsustainably large because they're never fully cleared out. So at some point they have to go down via a mix of inflation because of the money printing that they do to reduce the debt burdens by monetizing them. That's what every government does when they get into this situation. They blow up their currency because there's no other option. There's also debt restructuring, but that's not as popular, and paying debt service in a non-depreciated money, which is also depressing. And this is what we've been experiencing. It's why debts have been increasing relative to incomes at the same time as each cyclical rise and cyclical decline in interest rate. It's why debts have continued to increase relative to incomes, while interest rates keep going down in the long term until we hit 0%. So fundamentally, one person's debts are another person's assets, and one person's spending is another person's income, which means when there's a lot of debt outstanding, it becomes impossible to make things good for both debtors and creditors. Because if you help the debtors out, what are you doing? You're screwing the creditors. And again, one person's spending is another's income. And when this credit and debt creation is curtailed to bring in spending in line with incomes, this causes investment, asset prices, and incomes to fall, which cuts spending, and that's depressing. So the kind of debt system that we run on and with these cycles, it becomes very dangerous. And they would be less dangerous if the central banks would do their job properly. So what the central bank should be doing is steering the economy like a good driver, meaning they have a gentle application of the gas and brakes. That way they produce steadiness rather than hitting the gas hard and then hitting the brakes hard, because that leads to lurches forward and backward, which is exactly what we do now. Instead of having a more stable economy that goes like this, we're more like this. The other thing they should be doing is keeping debt assets and liabilities relatively stable. And most importantly, don't let them get too big to be able to manage. So by these measures, our central banks have not been doing a good job. So right now, the Fed is moving from printing and buying debt at an annual rate of 1.5 trillion to selling it at an annual rate of 1.1 trillion. And they're going from sharply lowering interest rates to sharply raising them. And that's why we experienced a big jump forward these last 10 plus years. And now we're going to get hit with the big backwards push in the recession. And right now, because debt assets and liabilities are so high, and because government deficits are so high, basically impossible for the Fed to push interest rates to a level that are high enough to compensate those holders of the debt assets, considering how high inflation is, without those interest rates being too high to support strong debtors, strong markets, and a strong economy. So basically, the Fed won't be able to push interest rates high enough to counter inflation and pay off the creditors. Or if they did push it that high, it would hurt the economy way too much, because you got to take care of both sides, right? But then the problem is, if the holders of the debt don't get adequate returns, and these are the creditors, they're going to sell that debt, which worsens the debt supply and demand picture, which leads to a cutback in credit, which is bad, right? Less spending once again. Or the central bank creating more money and buying more debt to fill the void, which is inflationary. So Dalio's main points are that 1, there isn't anything that the Fed can do to fight inflation without creating economic weakness. So there's no soft landing that people are talking about. It's going to be a hard landing. This is the same thing that Druck said. And 2, with debt assets and liabilities as high as they are and projected to increase due to government deficit, and the Fed also selling government debt, it's likely that private credit growth will contract, which will weaken the economy. They are going to lend out less. And over the long run, the Fed will most likely chart a middle course that will will take on the form of stagflation. And what is stagflation? It's a combination of economic stagnation, high inflation, and high unemployment. It's a terrible cocktail. So it last occurred in the 70s when energy prices increased due to oil embargoes, and we had other macroeconomic pressures. And that's when Paul Volcker came in the 80s and jumped up those interest rates, and that's why he's credited with helping to alleviate that period's economic woes. So unfortunately, it looks like we're in that type of 70s scenario again. And it's always good to see what a guy like Dalio is talking about and then compare it to what another smart guy like Druck is talking about. And we just made a video about Druck's latest views right here. And surprise, surprise, it doesn't look good for the economy. But there are a few interesting explanations that Druck gives that are worth listening to. So click this video right here, and I will see you there.